Okay, so the UK housing market is significantly overvalued and is teetering on the edge of a significant decline. But let's be honest, it's probably well overdue. This is the average house price to income ratio. It currently sits at an average of 7 times income, and in London it's even worse. Now, as of right now, the average UK house price sits at £281,684. That compares to the early 1990s, where house price to income ratios were just 3 times your average income, and the average house price back then was just £51,000. But there's certainly a lot more to unpack here rather than just comparing price relative to income. So let's talk about interest rates. Warren Buffett once said that interest rates are like gravity on stock prices, but it also works exactly the same for other asset classes too, like property. The higher the interest rates go, the more expensive it is to borrow money, and because of that, affordability comes down as a result. Now, believe it or not, interest rates back in the 1990s actually topped out at about 15%. Naturally, at the time, I guess you could say making houses less affordable. But stick with me, because this is where the numbers become quite unfathomable, especially when you compare it to today's numbers. Let's be honest, seeing a Bank of England base rate rising quite rapidly to 4% has a lot of people worried about their mortgage repayments. And actually, it's been reported that about 50% of people do actually worry about paying their mortgage, and that's not a nice place to be in. But just imagine in a hypothetical world that interest rates were to go up to 15%, but on today's current house prices. For context, if let's say you had a £250,000 mortgage, which is probably about right if you've got a 90% loan to value on your average house price of about 280k, if interest rates were to go to 15%, your monthly mortgage repayments would be over £3,200 per month. Now, if you consider that the median UK salary right now is £33,000 per year, that would mean your take-home pay would be £2,205 per month, which calculated as a percentage of your mortgage repayments would be 145% of your income. You simply wouldn't be able to do it, and your house would be repossessed. But even when you double that income to £66,000 per year, assuming you've got a 2-person household earning the median level of income, that would still equate to 72.5% of your take-home pay being used to repay your mortgage. Now, banks actually consider anything above a 45% debt to income ratio as a red flag, and as a result would likely reject your mortgage application. Now, of course, that is just a hypothetical example. Interest rates, I hope, aren't going to 15%, or at least not anytime soon. However, it is just more of a direct means of a comparison to what house prices looked like back in the 90s. Because if we do go back to the 90s, the only reason why interest rates were so high was because actually at the time, houses were far more affordable. And even despite interest rates being at 15%, actually the average debt to income ratio was about 20%. So what I'm trying to highlight here is, with a relative comparison of income, interest rates, and mortgage debt, just how expensive house prices are now compared to what they were just 30 years ago. It's the reason why people are struggling to buy homes and why houses are actually so unaffordable, but in real terms. But why exactly are house prices so much higher now than perhaps they've been in the past? Because in order for house prices to continue to rise, people like me and you guys must still be buying them. Which is true, but in recent years, the incentives for home ownership have got even bigger. Stamp duty land tax holidays saved people thousands and thousands of pounds during the pandemic, albeit it did come at a cost to the UK government of about £6.4 billion. Because let's be honest, when people thought that they were saving money on their stamp duty, in actual fact, it just mentally gave them a higher budget for the house that they could afford to buy. And as a result, the government stimulated a housing market boom, leading to record growth rates just at the time that we didn't need one. Thanks for that, Boris. But that's not all, because on top of that, the government have, or at least had, home buying schemes, something called the equity loan. It was where you only needed to put down a 5% deposit and the government would top you up with the rest, anything up to about 20% of the value of the property. The only caveat being the government actually owned the percentage of your house until you paid it back. So the government kind of had you by the balls. If you wanted to sell your house, and let's say the value of your house had gone up by 10%, the government would go on to take their portion of the gains depending on how much money that they lent you in the first place. Now, certainly appreciating that it probably helped thousands and thousands of people get onto the property ladder as first-time buyers, it's only done so at the further expense of all home buyers, because it stimulated property prices again. Because as we all know, when you just magic up free money, it justifies the value of those properties, whatever those prices may be. And that really is the problem to these kind of government-backed schemes that help stimulate the property market, because it's only very one-sided from a two-sided equation. Because the truth of the matter is, it only ever supports market demand. And when you have anything where demand continues to rise and supply isn't keeping up with demand, well, prices will inevitably increase. And they have done so here in the UK at a rate of 67.9%. just in the past 10 years. That is the equivalent of a compounded annual growth rate of 5.3% per year, which of course is great if you're an investor in the UK property market. Not so good if you're a person looking to get on the property ladder or move up it. So how exactly do we prevent house prices becoming completely out of control? Well, me and you guys can't really do anything, but the government and the central bank have two options: affect demand by increasing interest rates and squeeze people financially. So we've got a big tick in that box already, but the other and more important option is actually to increase property supply. In my opinion, instead of helping all of the people get on the property ladder with equity loans in the past few years or so, the government should have actually spent that money instead on building new properties so we had more in supply, which should hopefully make prices a little bit more reasonable. Because the truth of the matter is we have a huge lack of property supply here in the UK right now. In actual fact, we're building less than half of the homes that we were building back in the 1960s, despite the UK population growing from 52.4 million in 1960 to 67.3 million in 2021. So we've got an additional 15 million people to house, but the rate of growth on new properties is half of that of what it was 50 or 60 years ago. And the government know this because they've even published a research paper which is titled "Tackling the Undersupply of Housing in England," where they've actually set out a target to be building 300,000 new homes per year just to be able to keep up with demand. And well, as at the last 16 or 17 years or so, the net supply of new properties has been well under the amount that we actually need. So look, I think it just so has it that we're actually having a well-needed house price decline, or perhaps even a house price crash. Official reports are already showing a material decline in house prices. However, I don't think that there will be too much of a decline, because fundamentally there still is a lack of supply and an underlying demand for UK property. But having said that, there still is very much room for a healthy amount of downside to bring houses back down to more reasonable levels, I guess you could say, in the coming year ahead. But in all of this, perhaps it's just a UK problem about how we actually think about home ownership. The French call it the English disease, because of our appetite to actually have so much debt on our hands. And the reality is we do have a debt problem here in the UK. We're actually some of the most indebted people in the world, with our average household debt as a percentage of our income being about 135%. So for every £1 in income that we make, we have £1.35 in liabilities, which is a pretty staggering statistic. I mean, it's kind of got me thinking that surely there must be a better way to go about more efficiently managing our finances. Sure, debt can be a good thing if it's leveraged positively, but let's be honest, most of the debt that we have in the UK is for the houses that we live in, the cars that we drive, and our bad spending habits, none of which are assets that are going to put money back in your pocket over the long run. Now, if we compare that to other countries in Europe, let's say their debt to income ratios are actually substantially lower, with the French having a debt to income ratio of 104%, and Spain, Germany and Austria are actually well under 90%. So perhaps we should care a little bit less about home ownership and adopt some of the habits of those on the continent, living well below our means and not having so much debt on our hands. But fundamentally, how does this all change with the UK property market? Well, the truth is it probably doesn't. It's just the way that the country's programmed. And unfortunately, it just kind of feels like the UK property market has become somewhat of a Ponzi scheme, with the UK government creating money out of thin air to stimulate the housing market through various government-backed schemes, just for the next generation to be burdened by growing levels of government debt there in the future. But despite all of this, I think the reality is we'll all still continue to buy homes. We all have the aspiration to own our own home one day, regardless of the price that we pay. Inevitably, we'll just buy what we can afford. So for the most part, at least as it stands anyway, with our current attitudes to home ownership, that this kind of housing market bubble, if you like, is probably here to stay over the long run. So it is kind of just a case where we'll probably just have to suck it up and market forces will make the decisions for us. So having had a little bit of a rant about the UK property market, if you are interested in the current or the most recent data on the UK property market, then be sure to click on this video next. With that being said, see you over in the next one.